Hello, good morning. My name is Dr. Chidera Ugwani, and I'll be facilitating this course, ACC884, Taxation and Public Finance. Today, we'll be beginning this discussion by first trying to understand what taxation is, to create a good foundation for our discussion going forward. So we'll be trying to understand what taxation is, the types of taxation, types of taxes, and the different tax systems that applies in Nigeria, as well as other foundational issues and concepts that will help us to understand our discussions going forward. First, when we mention the word tax, a lot of people become apprehensive. From experience, when you discuss or when a company receives a letter from a tax authority, be it the Federal Inland Revenue or the state tax authorities, they become frightened, because for them, these people are coming to cause trouble. These people are coming to, look out ways to extort money from us. In principle, that is not supposed to be so. So when we talk about tax, tax is a levy that is enforced. It's a compulsory levy that is enforced on the incomes of individuals, the incomes of organizations, and on some certain transactions. So invariably, we don't tax a person, we tax his income. We could take some definitions. Here we have that a tax is a compulsory contribution levied by a sovereign power on the incomes, the profits, the goods, services, and properties of individuals and corporate persons, trust and settlement. Such taxes, when collected, are used for carrying out governmental functions, such as maintenance of law and order, provision of infrastructure, health and education of the citizens, or as a fiscal tool for controlling the economy. So, as you can see, it is compulsory. It is backed by law that an individual, a company, or a particular transaction the tax should emanate from such transaction. And it is expected, I use the word expected, that when these monies are collected by the sovereign power, which in our own case is the government, they should be used as a means of redistribution of income to provide services that are consumed by all and sundry, such that we can all afford those services and make and take advantage of what they provide. If we go further, one may want to know, what are the objectives? What's the purpose of taxation? As I've mentioned, the primary purpose is a means through which government raises revenue. In principle, in our country, Nigeria, aside oil, taxation is the highest revenue generating means for the government. And it's through this taxation that most government expenditures are catered for. So, if we look at other reasons, other objectives of taxation, we've mentioned is a revenue generation means. It's also a means to redistribute income and wealth. By that, we mean that income from the rich Through taxation, we can get money from the rich. Ordinarily, a tax system should be progressive. You can get money from the rich to provide services that the poor can also make use of. So that way, there's a redistribution of wealth. There's a redistribution of wealth. So this objective seeks that present distribution of wealth has been unjust, and so there's an attempt to reverse the situation by fixing taxes at concessionary rates in favor of the poor. So the poor pays little, the rich pays more. Together, these monies are used to provide good services, infrastructure that we can all make use of. For example, if we do not have public universities which are built with taxpayers' money, maybe the children of the poor may not be able to afford university education today. If we take a sample of the fees paid by most of the private universities, you will find out that most people will not be able to afford university education. But for the effective use of taxpayers' money, we can have public universities that the fees are subsidized such that everyone should be able to get in, should be able to foot such bills. Another objective is that taxation is a means of managing the economy. It's a means of managing the economy. Through taxation, the government can use taxation as a fiscal weapon to plan and develop a country. It is used to achieve certain economic objectives, such that at some point they could decide to encourage small and medium enterprises by granting some tax holidays, or to encourage private investment, and to encourage foreign investors by granting some tax waivers, such that so that they can invest their business, help the economy to grow, and sustain the livelihood of people. Also, sometimes taxation is used to encourage or to regulate the consumption of certain products. At times, we understand that alcoholic products, what's it called? Some alcoholic products, cigarette as well, are highly taxed. The essence is that with a high taxation, the prices will go high, and that way we try to discourage and regulate consumption of such products. So taxation can be used to encourage or to grant incentives to investors, as well as to dissuade consumers. Also, taxation can be used to harmonize economic objectives. To harmonize economic objectives of different countries. For example, the tax system can be employed by a member states of ECOWAS as a means of granting within themselves free trade to push the economy of the region. Also, taxation is a device to improve the gross national income. As we said, it induces economic development, and it tries to influence a favorable balance of payments with other countries. So these are the key objectives or the purpose of taxation. Now let's just look at the tax systems and the type of taxes. First, the tax systems. We have three tax systems of methods of taxation, or methods of taxation. First is a proportional tax. Second is a progressive. Third is regressive. A tax system is said to be proportional when all the tax payers are liable to a flat rate. The incomes of all taxpayers are subjected to a flat rate. Irrespective of the income, they are subjected to a flat rate. For instance, at a flat rate of 20%, a taxpayer with an income of 100,000 will pay 20,000. Another taxpayer with an income of 1 million will pay 200,000. Everybody is subjected to a flat rate of taxation. That's proportional tax. The progressive tax system is a form of tax that provides for a graduated scale where a higher rate applies as the income increases. The higher your income, the higher the rate of tax applied to you. Our country, Nigeria, is one of the examples where we have a progressive tax system when it comes to personal income. You can see the table, the graduated scale. An individual whose taxable income is within 300,000 is subjected to a tax rate of 7%. If it's more than 300,000, the second part of the 300,000 is subjected to 11%. If it becomes more than 600,000, the remaining part is at 15%, and and so on and so forth. So it's a graduated scale. It's a progressive tax. The higher income earners are subjected to higher rates of tax. The lower income earners are subjected to lower rates of tax. Now we also have the regressive tax. Regressive tax. Under this type of tax, the tax payable decreases as income increases. It is a reverse of the progressive. So the higher your income, the lower the rate you pay, the rate that applies to you. Obviously, this system is hardly found. However, it is possible that there are places where they exist. Well, as bad as it seemed to appear, it could be an incentive for people to work hard, because when you make more money, you pay lesser tax. Now let's look at the type of taxes. We have two different types of taxes: direct taxes and indirect taxes. The line of difference, or the issue that demarcates these two, is that the incidence of tax falls on directly on the taxpayer. It is direct. For direct taxes, it's directly on the taxpayer. The indirect taxes is not directly on the taxpayer. Examples suffice. Direct taxes include things like personal income tax. It's suffered directly by the individual who is paying the tax. Company income tax, capital gain tax, tertiary education tax, petroleum profit tax. The individual or the company that is paying either any of these tax types has a direct feel of the tax burden. On the other hand, indirect taxes are imposed on commodities before they reach the consumer, and they are paid by those upon whom they ultimately fall, not as taxes, but as part of the selling price. So a lot of times, you and I, when we make purchases from the stores, we pay taxes without knowing we just pay tax. A lot of goods we buy today have value-added taxes on them. But because they don't, most of the time, we don't even know that these are taxes. So they are indirect. They are not, the burden of the tax is not on us per se. The tax is levied on the products or transactions that we engage in. And we pay these taxes even without knowing them. Value-added tax, stamp duties, custom duties, excise duties, and all whatnot. When custom duties are imposed, the eventual selling price of the product carries such duties. And we buy them at those prices without knowing that we have paid taxes indirectly. Let us look at some fundamental concepts in taxation. First is the tax base. The tax base. The tax base is a measure upon which the assessment of tax liability is based. In simpler terms, it is the thing that suffers the tax, be it income, be it a property. Is that portion of the income that is taxed. When I mean the portion of the income that is taxed, the tax law provides for some allowances. So there are some things that are allowed by the tax law as part of your income, as part of an individual's income that is not taxed, as part of a company profit that is not taxed. So the portion that is taxed that's the tax base, or the property that suffers tax in cases of capital gain taxes. The second is the tax rate. The tax rate is the ratio at which a business or a person is taxed. The ratio. For example, in Nigeria, company income tax is 30% of assessable profit, or rather 30% of taxable profit. The taxable profit is the profit gotten after all adjustments have been made. Value-added tax, as at today, is 7.5% of the vatable goods and services, with effect from February 1st, 2020. VAT is at 7.5%. And grapevine information shows that there are plans to also increase VAT furthermore as oil revenue continues to dwindle. The government is seeking for ways to raise their revenue generation from taxes. So the tax rate is that ratio, that percentage that is applied to a business or to a person's income. Also, the tax yield. The tax yield is a return in form of tax revenue derived from the administration of tax on taxpayers. So for a government, the tax yield is the amount they generate from tax revenue. If they generate 10 billion, that's the tax yield through tax revenue. That's the amount generated through taxation. And then the tax incident. The tax incident refers to the person, the eventual taxpayer, the person that takes that has the last fill of the tax. For example, if government decides to impose tax on cigarettes, the producers may increase the selling price by that amount of tax. Consumers will buy that cigarette at the increased price. Therefore, eventually the incidence of tax or the tax incidence falls on the buyers, not on the producers or the sellers. So the person who has the ultimate feeling or who takes the ultimate effect of a tax, that's the tax incident, be it a person or an entity. So the incidence of tax may be borne by someone else who does not even know when and where the tax was paid, just like in the example I just gave. And then the tax burden. Tax burden is the amount of income, property, or consumption tax levied on an individual. The actual amount of tax paid is a tax burden. So if a person has a taxable income of 1 million, which is the tax base, which is taxed at 5%, the tax rate, and 5% of 1 million should give us, say, 20,000, if I'm not mistaken, which is the tax burden. So the actual amount of tax levied on an individual or business is the tax burden. Okay, we also have terms like tax impact, which is the effect of tax on production and consumption. For instance, an increase in tax on alcohol would affect prices and may possibly lead to a reduction in sales. Also, the tax effect, which is more the consequences of taxation. Now let's take a look at the tax laws in Nigeria. A lot of tax laws exist in Nigeria to give guidelines and they describe the legal implication of taxes. These tax laws provide legal backing to the administration of each type of tax and clearly states the applicable rates, as well as the offenses, the penalties and interest that accrue, and also the best practices in the administration of such taxes in terms of ethical and professional conduct of the tax authority. Some of these tax laws include the Company Income Tax Act of 2004 as amended, the Personal Income Tax Act, the Petroleum Profit Tax, the Federal Inland Revenue Service Establishment Act, Education Tax Act, Capital Gains, Value Added Tax Act 2019 as amended now, stamp duties, and all whatnot. Now, one thing that is good to note is that each of these different tax types are guided by tax laws and backed by, an act of the National Assembly. And the administration of each of these taxes must follow the act. If not, anything in breach of this act attracts penalties and interest.